In the United States, the thing that really drives the economy has an influence on real economic activity, as obviously, and also inflation, are changes in the money supply. And what we've had since about the summer of 2022, the Fed has thrown things in reverse, and we've had a contraction in the money supply. And the stock of money in the United States now, measured by M2, that's the broadest measure the Fed has, is actually lower than it was in June of 2022. That kind of contraction has only happened 4 times since the Fed was founded in 1913. And all 4 times we had recessions that followed the money supply contraction. And actually, one of the 4 times was 1929, 1933. You know what happened then. We had a Great Depression. Of course, the money supply really contracted. It went down by about 38% in the Great Depression era. So a slowdown is pretty much baked in the cake, because the way it works, you get the change in the money supply, the slowdown in the money supply, and then it takes a while for it to transmit into the economy. And it's taken actually quite a while this time. I thought we'd be slowing down before now. The reason we didn't slow down quite as fast as we normally do is that after the pandemic, the Fed goosed the money supply so much that there was so much excess cash balances in the system that it took a while for that excess to burn off. And it did burn off late last summer. And now we're kind of running on fumes, shall we say. So that's the background in the United States. We've got a new administration in which there are a lot of changes being made, and something called regime uncertainty, I think, is setting in. And what I mean by that, all the rules of the game are kind of changing, and people become very uncertain about their private property rights and the rights that they have. They might own the title to something, but the question is, what's the free cash flow going to be from that, whatever it happens to be? So we have this regime uncertainty, which it's different than uncertainty. Uncertainty is kind of spotty, this thing and that thing could happen. But regime uncertainty basically means, you're upsetting the apple cart, changing everything. The best example of regime change uncertainty in the United States was the New Deal with Franklin Delano Roosevelt. Now remember, the propaganda about the New Deal was happy days are here again. It wasn't so great. There was a lot of regime uncertainty. There was nationalization of property, big changes in the tax code, changes in union rights. Many new bureaus and agencies were set up, and the expansion of the U.S. government was quite large. The grabbing hand of the U.S. government became a lot more significant. For example, just on the monetary part of the thing, the gold clause was abrogated. That happened in January of 1934. Now, what the gold clause said is that any dollar-denominated bonds that had been issued under the gold clause gave the owner the right to principal and interest being paid in dollars or gold. And gold at the time of the issuance of the bonds. Well, all of that changed when they abrogated the gold clause in 1934, and the dollar became 41% lighter than it was before. So that's part of regime uncertainty. The whole monetary scheme was being changed. We had nationalization, we had tax the rich, we had union power, we had this monetary change, all in the name of a national emergency. We have a national emergency, the Great Depression. Happy days are going to be here again. We have to make all these changes. Well, what happened is that investors became very uncertain about the veracity of their private property rights. And as a result, they hunkered down and they stopped investing. So from 1929 until actually after World War II, there was almost no investment in the United States. And what the regime uncertainty did, in a nutshell, it elongated the Great Depression. It made the Great Depression last much longer than it would have if we hadn't had all these regime changes. So that's what we have with the current Trump administration. And you mentioned tariffs. Well, yeah, tariffs are actually one thing, but you've got the rule of law with retribution coming in. International relations. Well, we basically got everybody in the world mad at us, with the exception of a few countries. And President Trump, he wears 2 sets of clothes. On Ukraine, he's the president of peace. in the Middle East, and including Iran as the main target. He wants war. And then we've got Elon Musk and Doge in there restructuring the government. And we also have something going on, a lot of ex post facto laws coming in because, for example, universities have research grants. They've taken a lot of those away or stopped payment on them. They're breaking contracts. A research grant, it's just not a gift they're giving the university. The university has a contract to do research, and they wouldn't have to renew those, but to just stop them in mid-track. That's ex post facto law. You find that in developing countries. This is all in regime change uncertainty, and that comes into play because if the economy is slowing down because of the monetary contraction and might go into a technical recession this year, add to that regime uncertainty, and you got a real problem on your hands. So U.S. is negative. Forget the Make America Great Again mantra. It's very doubtful if that's going to happen. Tariffs are a complete disaster. They're not going to make America great again. They're not going to change the trade deficit that the U.S. has. So that's the U.S. Europe's been in a complete slump since the great financial crisis in 2008. And now Europe, they want to go to war with Russia. They're becoming more militaristic. And if you look at the budget, the UK, for example, it just came out yesterday, the Chancellor of the Exchequer, Reeves, wants to increase military spending and reduce welfare spending. Well, I don't have any problem with reducing welfare spending, but you're increasing military spending. You think that's going to be very popular in Great Britain? You're just asking for trouble there. And by the way, Europe's gross national product since the great financial crisis in 2008, it's been flatlined. The U.S., in comparison, since 2008, gross national product in inflation-adjusted terms, it's gone up about 25%. Europe is nothing. Now, we go to China, which, of course, is a huge economy. They have a lot of problems. They've had this housing crisis. They were over-leveraged. Now they're deleveraging, so they kind of have a balance sheet slowdown, shall we say. In addition to that, the money supply is growing at an anemic rate. It's too slow. Growth rate in the money supply in China is 7%. Hanke's golden growth rate for the money supply growth measured in M3 in China is 10%, and that's a rate consistent with hitting China's new inflation target of 2%. So they're in a balance sheet sort of recession where they're deleveraging. The money supply is not growing up to the point where it should grow, and as a result, they're actually in more or less a deflation. There's no inflation in China, so China's in big trouble. I think this year we'll probably see the headline CPI number come in at 2%. That's the Fed's target. We might even get a few months where it's actually below that. But remember, the key to this is how to think about it. The reason for this is what was happening with the money supply a couple years ago, not what's happening today. There's always a lag between changes in the money supply, changes in asset prices, changes in real economic activity, and changes in inflation. And most people are just watching the day-to-day data. They have no theory of national income determination. My theory that I'm articulating with you is the quantity theory of money. And most people don't understand the quantity theory of money. Even the Fed, the central bank, poo-poos it and indicate that, as Chairman Powell likes to say, we know of no reliable connection between changes in money supply and changes in economic activity. So when we talk about a model for national income determination, well, what is a national income determination? That's nominal GDP. We're trying to look out ahead and get some idea of where nominal GDP is going. Now, nominal GDP has two components. One is the real rate of growth in the economy, and then you have to add to that the inflation rate in the economy. If you add those two growth rates together, you get nominal GDP. And that's what the quantity theory of money tells you or allow you to understand. And with the contraction we've had in the money supply, nominal GDP is slowing down. And I think the real component will slow. And Add to the picture the regime uncertainty, and we might even see a recession late this year. And I think inflation, which is 2.9%. John Greenwood and I said at the end of last year, between 2.5% and 3%. Well, it was 2.9. That was pretty good. We did get that right. The one thing that I will say is that using the quantity theory of money, there have been, in this up and down cycle, there have been four things that we've been trying to get our head around and forecast. And that is, on the upside, what was going to happen to inflation and what was going to happen to real economic growth. Greenwood and I nailed that. We said inflation would go up to 9%. It went up to 9.1%. And we said we'd have a strong real economic activity. We did. Then on the downside, we got the inflation part right, but we anticipated we'd be slowing down even last year. Well, we didn't. So we got that wrong. So we got 3 out of 4. It's pretty good. No one comes close to that record. What they like to do is point out, they say, oh, Hanke, you said we were going to have a recession in 2024. We didn't. You don't know what you're doing. Your monetary theory and the quantity theory of money is rubbish. No, it isn't rubbish. We didn't get it right because there was such an excess of cash balances that had built up and was overhanging the system and allowed people to keep spending, and that allowed the economy to keep booming along and not slowing down as fast as we would have normally expected it to. The key thing is look at the inverse of velocity, and it's the money supply over nominal GDP. That's what went way up above trend, and that's where the inventory of the excess, it was the inverse of velocity, the money supply over nominal GDP. If you had a trend line, usually the thing just goes up at about 2% per year, the money supply over nominal GDP. It wiggles around, but it's pretty much a linear line. So the linear line, all of a sudden, with a huge increase in the money supply that started in February of 2020, the thing jumped way up above the trend. And it came down and crossed the trend line late last summer, and now actually is a little below the trend. But it'll come up and it'll start wiggling around the trend again, unless the Fed does another stupidity, which of course they might do.